Hello and welcome everyone to our Smart Women Savvy Money March webinar. We're very happy that you're here because you're going to hear about a very important topic today because as we know, this year has started out with some real challenges. But for the first time in a very long period of time, you will understand the benefits of investing in bonds. First off, my name is Renee Norris, the founder and CEO of Urban Wealth Management and Smart Women Savvy Money. The reason why we call it Smart Women is because women are smart. And it is our objective to help you get savvy about your financial life. That is what our focus is. And we know how to do it. Having said that, the topics that we are going to be discussing here, not only is it that we focus on investing by any means, but on your financial life. We've been in existence for 10 years. However, the Smart Women Savvy Money Group has been around now for 8. We've been hosting these monthly webinars really since about the last 8 years. And that has been amazing because of the fact that we focus on what is going on in your life and the changes that you may need to make in order to get your financial life in gear. So, with that said, first off, I would like for you to know how to connect with us. If you have not already been to our site, we have some updates that we'd like to share with you. First off, at Urban Wealth Management, we have a great site that shows what all of our services and our benefits are. And when you come into the site, you'll be able to see everyone. But also, when you come in, you go to the Smart Women Savvy Money, click on that, and that takes you into our site. In addition to that, we have a Smart Women Savvy Money website. Here, if you log in, you'll have the opportunity to see and hear the entire webinars that we have hosted over the past 8 years on a variety of very important subjects. So it doesn't cost anything to do that at all. And we also have a Smart Women Savvy Money Facebook page. So you can come visit us there as well. So with that said, I want to turn it over to Alex White, who is with PIMCO. And they're here in the Newport Beach area, not that far from us here. As you all know them as PIMCO, but their specialization is focused on bonds, fixed income. And this is a topic that's so important right now, given the fact that we are seeing interest rates starting to head up. So today's topic is investing in stocks. You need to be a bond girl too. So with that said, I'll turn it over to you, Alex. Thank you for your time.
Great. Thank you so much, Renee. I really appreciate that. Can you hear me okay and see me okay?
Yes.
Wonderful. Okay, so I will get the presentation that I'm going to be using today up on the screen. I've been at PIMCO for about 5 years now. And as Renee said, PIMCO is the largest actively managed fixed income manager in the world with over $2 trillion of assets under management. So those assets include money belonging to both institutions and also individuals like yourself. And they're usually housed in one of our various mutual funds. So we run funds that include equities and alternatives, but we focus primarily, as Renee said, on fixed income, which is the asset class that we'll be taking a little bit of a deeper dive into today. So we'll discuss what a bond is, how the bond market works, and the value fixed income can bring into a portfolio, which are all really important factors to consider when you're investing in the asset class. So we won't cover every single slide in this presentation, but I wanted to include all the pages in case you want to go into a little bit more detail on your own when you have the time. I want to start with a little compare and contrast of the equity and fixed income markets, because I know it's a little bit more common to be familiar with the equity market, and we can use what you know there as a good starting point to dive into the fixed income market. So we'll go to this very colorful what slide to start off. So it's very common within investing for individual investors to be familiar with the stock market and how equities function. And that's mainly because it's a pretty broad spread topic and it's covered by many news outlets. And it can also be used as a barometer of how the economy overall is doing. So that's how that news is communicated. The fixed income market is a little less known and less spoken about, even though the size of the market is a little over $40 trillion. And that's just in the US. Internationally, it's over $100 trillion. So it's a pretty large investment opportunity that can be overlooked if you're only looking at equities. While equities, as I'm sure most of you know, are shares of ownership within a firm, fixed income or bonds are a loan from a lender who's the buyer of the bond or the holder of the bond to a borrower who's the issuer of the bond. By owning a bond issued by a firm, you don't have any ownership within that entity. And I say entity because not only firms issue bonds, but governments and states can also issue bonds. But the entity owes you the full amount of the bond at some time in the future, and they'll pay interest on that bond until it matures. So with that background, let's dive a little bit deeper into what a bond actually is. So bonds are loans from a borrower to a lender. The borrower can be a company, a state, or a government, and they typically issue bonds to raise money for a purpose or a project. So a good example of this is, think about Apple. Apple may issue bonds to raise money in order to fund their research and development, or maybe fund a new product launch, whereas the state of California might issue bonds for a specific project, such as building a state hospital or maybe a state highway. So like a basic loan, the borrower will pay a specified interest rate on the bond periodically. That's where the name fixed income comes from. And then they'll pay the full amount that they initially borrowed at the end of that loan term. So the interest rate that the lender will receive throughout the life of the bond is it's a percentage of the actual upfront loan value, which we call the principal or the par. It's just the amount that you loaned initially when you bought the bond. So say you buy a bond for $1,000. The par value, the face value, the principal is all going to be $1,000. That's what you'll receive upon maturity of the bond. And then the interest rate and the interest payment that you receive on that bond periodically is called the coupon. So the terms of each bond are contractual and written into an agreement with specifications called covenants, which we'll discuss a little bit more later. But basically, every nuance about the issuance will be written into that contract. So you'll be able to look a little bit deeper into exactly what you're investing in. So understanding the coupon payments, the par value, and the maturity provide a really good foundation for understanding the fixed income class and what a bond is just in general. I wanted to touch on this slide just briefly. It's a little bit of history about fixed income. So the first bond was actually issued in the 1100s in Venice as a tax that would be paid back. So how nice would it be, right, if taxes work that way these days? It's a little bit different now. They've evolved a lot, and now they have many different types of issuers. But I thought that was a little interesting tidbit as to how they got started. So let's dig into that concept that I just mentioned about issuers. So if you think about the different asset classes that are subcategorized in fixed income, you can think about it as the asset class reflecting the issuer of the bond. So like there are different sectors and types of equities that you can invest in, think value versus growth or technology versus manufacturing. There are various asset classes that fixed income can be subcategorized into as well. So the first one listed here is government or sovereign bonds. These are bonds issued by a country's government and tend to be the highest quality above any other bonds in the fixed income asset class. So next is the government-related bonds. These are also known as quasi-government bonds, and they're issued by government-backed or government-related borrowers, like government institutions or agencies. So you can think about Fannie Mae or Ginnie Mae as an example there. The next thing on this slide is a corporate bond, which are usually issued by a company, similar to the Apple bond that I mentioned earlier. So it'll generally offer a little bit higher yield, potentially a lot higher yield than a government bond in order to compensate the lender for the additional risk that they're typically taking when they're lending to than when they're lending to a government entity. So think about if the government issues a bond, and then upon maturity, they don't have the cash that they need to pay you back for that bond, they can print money to pay you back for that bond. They have that ability. Whereas Apple or maybe Microsoft or for some reason, all I can think of is tech companies right now. If one of them decide to issue a bond and upon maturity, they don't have the cash to pay you back, they can't print money. So there's a little bit more risk in that, right? So that's why they have to pay you a little bit higher yield or coupon in that circumstance. The last type of bond listed on this slide is a securitized bond. And these are bonds that are backed by assets, usually identified by the name. I'm sure you're very familiar with a mortgage-backed security or maybe an asset-backed security. And this just means it's a bond that's backed by a pool of mortgages or a pool of maybe auto loans. And those are more substantial assets that the bond is actually tied to. So after this slide, we have a pretty good idea of what a bond is and who issues the bonds or sells them. Now let's get a little bit more into the details about the mechanics of a bond. So I've mentioned the word coupon several times now. And just like a borrower pays interest on a loan, an entity who issues bonds will pay a coupon on that bond, right? The lender will receive the coupon rate periodically, like I mentioned, usually semi-annually, until the bond matures. So this rate is specified upon the issuance of the bond, and it's quoted as a percentage of the bond's face value, which is equivalent to the principal or par value. So if you buy a bond for $1,000 and the coupon rate is 5%, you're going to get $50 a year as interest on that bond. Or if it's a semi-annual bond, you'll get $25 twice a year. So the most common type of bond has a fixed coupon rate, like that 5%. However, some bonds have a rate that moves in accordance with a quote unquote benchmark yield. So the terms of the coupon are outlined in the bond's covenants and in the contract. So you can be well aware of what your income stream is when you purchase the bond. But in a fixed coupon bond, you can expect that coupon consistently on the period specified in the covenants. And if the coupon is tied to a different benchmark, then that payment can go up or down depending on how the benchmark moves. So say it's tied to inflation. Recently, you've seen inflation increase quarter over quarter for a few years now. So that if that was a benchmark rate, your coupon on that bond would be changing. It would be increasing, right? Because the benchmark yield is increasing. So that's a little interesting tidbit in how the coupon of a bond is determined. The next thing that we'll discuss about bonds is the yield. So most simply put, a bond's yield is its income return. So if you buy a bond right when it's issued by the borrower and hold it until maturity, your yield will be the coupon of that bond. So on the 5% coupon paying $1,000 bond, your yield is 5%. Because money now is worth more than money later due to factors like opportunity cost and risk of inflation, bonds that are issued for a longer time frame typically have a higher yield to compensate the investor for holding the bond for the entire time frame. So a good way to think about this is if you buy a $1,000 bond today, and let's say it has a maturity of 10 years, you won't have that $1,000 until the 10 years is over. They're going to hold that $1,000 and give it back to you at the end of the bond term. So it's likely that $1,000 10 years from now won't be able to purchase what $1,000 can today, right? That's what inflation does. So the issuer has to pay you a higher coupon to make it worth the cost over a long-term period. So they're trying to make it a little bit more enticing for you to want to hold a bond for 10 years rather than just getting your $1,000 back. 10 years from now, the higher the coupon is in the interim, the more likely you are to want to hold that bond for the whole time frame. So the next slide tells us a little bit, or the next two slides tell us a little bit more about the price of a bond. Both the coupon and the yield tie into the pricing of a bond. So after a bond is issued, it is issued from the lender. The person who bought the bond or the institution that bought the bond can hold the bond until maturity, or they can sell it to another investor in the secondary market before it matures. So the price at which the bond is sold before it matures in the secondary market is called the bond's market price. It's pretty intuitive. There are several things that impact the market price. So if the borrower is a high quality entity, or that's just another way of saying that the entity is pretty likely or highly likely to pay back the debt, the bond will be considered more likely to be repaid and it'll sell at a higher price because there's less risk there. So here we're introducing an important concept in the makeup of fixed income. And this is the concept that bond prices and bond yields have an inverse relationship. So this is a little bit nuanced and a little tricky to conceptualize. So we'll spend some time breaking it down a little further. Like I alluded to earlier, if a bond is issued by a high quality entity, the price of the bond will be higher. That means that the yield will be lower than other bonds issued by lower credit quality issuers. So this highlights the risk return trade-off that's pretty inherent in many investments, right? So the more risk you're going to take on, the more return you want as compensation for taking on additional risk. Because the bond is issued by the high quality issuer, it's less likely to default than the lower quality issuer. So that bond is seen as less risky. So the yield demanded for the bond is lower, and therefore the price is a little higher. If we flip to the next slide, it's kind of a nice visual to understand this concept a little bit more. To understand what drives the price of the bond and therefore the yield as shown here in opposite direction, you can think about loans over the past couple of years, right? René mentioned at the beginning of the call that interest rates are increasing. They've been increasing for a few months now. And they were at their lowest point in the beginning of 2020 when the Fed cut rates to zero. So it was a great time to be getting a mortgage on your house, right? When those mortgage rates were very, very low. So maybe you took out a loan then. If you borrowed money from a bank for a mortgage at that time near the lows of 2020, let's say you bought a mortgage, you got 2%. So to the lender, the bank, they would actually prefer that you were taking out a mortgage now because rates are getting higher. So they would be getting paid more in an interest payment on that mortgage. So basically, let's think about this in terms of a bond. So the mortgages that banks issue now are worth more to the bank than the mortgages that were issued in 2020 because they have a higher interest rate and, like I said before, a higher payment. Now you can think about this in the context of a bond. Say you lent $1,000 to an entity in 2020 and you're receiving 2% on that bond. If you lent another $1,000 to the same entity today with a coupon payment of 4%, the initial bond that you bought is going to be priced lower because you're getting compensated for the same quality issuer with a lower coupon payment. So there's less demand for the lower yielding bond, right? If something's yielding higher, you're willing to pay a little bit more for it to get that higher income stream. So that's how that works. There's several other factors that tie into the yield and price of a bond that are mentioned on the next few slides. We go through duration and spread and things that are a little bit nuanced. So I'll skip those for now. We can come back to them in Q&A if we have time. Otherwise, René has this presentation, like I mentioned, and I'm sure if you reach out to her, she'll be willing to go into those details a little bit more with you. We'll skip to a topic that a lot of investors dive into when they're investing in a new investment, which is what can go wrong, right? What's the worst case scenario if I invest in this new vehicle? Regarding fixed income, the worst outcome is that the borrower is unable to pay back their debt, which essentially means you lose the initial amount of the bond to that. Like if we were to continue using our previous example, if this bond defaulted, you would lose $1,000, right? So there's more limited downside there. You only lose your initial investment. I say only, but it's money you worked for, it's money that you thought about and you spent a good amount of time trying to invest the way that you wanted. So it's a loss regardless. However, there is a possibility that a portion of the debt is paid back. So for some of the most risky bonds, the amount paid back is generally around 40%. So you would get $400 of your initial $1,000 investment back, in addition to the coupon payments that you've been receiving since you bought the bond. So there can be some benefits to still being able to receive partial amounts of your initial principal. That's not always the case, but sometimes it happens even if a company defaults. We'll dive into why that is a little bit more later. So the higher quality of the bond, the lower probability there is of a default. So that's the difference between maybe a higher risk corporate bond and a government bond. Those government bonds are less likely to default, especially when your government is, say, the USA, right, or the Fed. They have a very built out system that allows them to continue to pay off debt that they take out. So ideally, you would receive all of your coupon payments and all of the principal amount of the bond at the end, which is what this slide explores a little bit more. But it is very good to be mindful of any downside risk in any type of investment, right? The last thing that I want to address when we're talking about the what part of a bond is the active bond management. So far, we've mainly considered investing in fixed income with a passive approach, which is viewing bonds from the perspective of buying a bond right from the issuer when it's issued, and then holding it until maturity or until that issuer pays you back. In reality, there can be a lot of value in buying and selling a bond at the market price that we talked about earlier during different times during that bond's life. Think about what we talked about in terms of what makes the market price. We can go back to the mortgage loan example. If you waited to purchase the 2% bond or the lower yielding bond until right after the higher rates came out, you could buy that 2% bond potentially at a discounted price, say $900 when it's worth $1,000. And then you'll receive the full par value of $1,000 when that bond matures. So that gives you a little bit of potential capital appreciation on top of the income that you're going to be getting, because you're going to receive that 2% paid annually or semi-annually regardless. So you'll get a little bit more of a growth factor in there, which some investors want in their portfolio. And you can determine that based off of the type of investments that you desire within your investment portfolio. So most active fixed income managers monitor bonds through the stages of their life, and they'll buy a combination of newly issued bonds and pre-owned bonds that they think are a good value in order to generate some income and, like I mentioned before, capital appreciation into their portfolio. Because of the complexity of this task, it's usually mainly only undertaken by institutions or large asset managers that have a lot of resources and a lot of traders, and less often by individual investors, even though it is possible and it can be done by individual investors. So at this point, we've gone through a lot about the fundamental aspect of bonds, and hopefully you have a pretty good grasp of what the security is. And I want to spend a little bit of time discussing why bonds are an important part of the investor's portfolio, which I'm sure, as you already guessed, relating to the title of this presentation, this is the why part. So like I was alluding to earlier, fixed income can provide both capital preservation and income. And those are just two of the different types of benefits that investing in bond holds. So there's several investment objectives that can be accommodated by investing in fixed income, which first we mentioned already on the slide is capital preservation, which is essentially owning a bond that creates an aspect of buying the bond at a lower price and then redeeming it at a higher price. So you get to receive the initial principal on a bond at maturity, no matter what price you bought it at, which can lead to a growth in capital, which is what capital appreciation means. The income component is basically what we talked about earlier of that coupon payment that provides a regular income stream, which can help plan for future spending needs. Next is the diversification aspect that bonds bring. They can act differently than stocks. So in some economic environments, bonds are up when stocks are down. A good example would be, let's say 2008 and during the Great Financial Crisis. In that year, when most stock indexes were down between 30, 40%, even more, the main bond index was up 4%, a little over 4%. So that's just a little bit of the benefit of diversification. And even though you might not want all of your portfolio in bonds because it wouldn't capture the total upside that the stock market had, say, like last year, it can still hold your head above water a little bit more in times when stocks are down. The next thing it can do is it can act as an inflation hedge. So bonds that have a principal or coupon, like I said earlier, that's tied to an expected inflation, they can provide a hedge because they're repriced according to what the inflation rate is. And that can help you in protecting your purchasing power over time. The last thing mentioned on this screen is capital appreciation. So when bonds are bought in the secondary market, similar to what we discussed regarding active management, they can offer elements of price appreciation as long as the price increases after the bond is bought. The next slide goes into a little bit about the cash market and why not just hold this money that I'm thinking about investing in fixed income in cash. Cash just seemed to be a little bit safer. It seemed to be a little bit more easily accessible. And the potential benefits of investing in fixed income that we reviewed on the last slide are reasons for investing in fixed income rather than keeping capital in a savings account or in cash. Like this slide alludes to, keeping money in cash can result in a loss of purchasing power, especially in a low yielding environment that has high inflation. So taking on incremental risk by investing in the fixed income market can help keep your capital in a lower volatility vehicle than equities, while potentially generating a return that can combat the loss of that purchasing power. So many investors who prefer to stay in cash do so because they see it as a riskless holding within their portfolio. However, holding cash can actually be a little bit of a drag on your portfolio performance by missing out on the yield of other asset classes. So this gives you a little opportunity to put cash to work in something that's maybe not as risky as equities, but still gives you a little bit of yield, which is what some investors use fixed income for. So if we consider levels of risk in the market and we were to compare investable assets side by side on a spectrum, we would start with cash all the way on the left, on the lowest end, which is the least amount of risk. Next would be the fixed income market with a little bit higher risk, followed by equities at an even higher risk. The spectrum can be expanded to include assets like real estate and private equity, but we'll focus on cash bonds for now. In general, assets that with risk will have a lower yield because, like I said earlier, there's no free lunch in investing where you get a high return without taking on a considerable amount of risk. So cash has a low risk and low return. In fixed income, you take on incrementally more risk than cash and you get a little bit higher return, and even more so with equities. This context portrays why fixed income has a lower yield than equities. Because bonds are a little bit less risky in general, they will have a lower yield. And that's not all bonds. Like I said, it can differ depending on who the issuer is and maybe the terms of the bond. But in general, for the purposes of a high level overview, bonds are generally less risky than equities. So as this slide explains, bonds are less risky than stocks because bondholders will be paid back before equity holders in the case of a bankruptcy. So think if a company has a bankruptcy and is liquidating its assets, they'll have to pay back all of their debt holders before they take any money from the liquidation to give to their shareholders. So that means you're a little bit higher in what's called the capital stack, and you'll get paid back among the first when they're liquidating their assets, which is seen to be a little bit less risky. So I don't know if this presentation has showed you at all, but bonds can be a little bit complex. So today I've described bonds from a pretty high level to hopefully help in laying the foundation for understanding the fixed income asset class. But there's a lot of factors to consider when looking into this asset class. And the next few slides dive a little bit deeper into the nuances with further detail between stocks and bonds and the differences that we touched on a little bit earlier. So I want to end with what I hope will be a nice transition into Renee's questions by going into the how portion of the presentation. So the next step to consider after understanding what bonds are and why they're a useful investment tool is implementation and how to implement a fixed income allocation into a portfolio. Like I mentioned earlier, some investors buy individual bonds and hold them until they mature. This can be a little bit of a complicated process because bonds are not traded on exchanges like stocks. They're actually what's traded on what's called a dealer market. Because of this, many investors don't hold individual bonds. They use commingled vehicles like mutual funds or exchange traded funds and managed accounts, which are most commonly employed to manage fixed income investments. So those are the most commonly employed types of vehicles. This allows a team of analysts and managers to review the details and complexities of each new issuance and determine the quality, the value of the investment, and then evaluate whether it fulfills the investment objective of that fund and if it lines up exactly how they would want it to. So that leads to the question, how do I decide what type of fund I want to invest in if I don't want to buy individual bonds, right? So choosing a vehicle that manages the type of fixed income you would like to have exposure to is where Renee and her team come in to help evaluate both your investment objectives and choose a fund that has the adequate focus, whether that be capital preservation or income or growth. They'll align that with your risk profile and with your return preferences, and they'll be able to make a suggestion based on the best approaches to implement based off of the conversations you've had with her. That's basically where I wanted to stop and see if you have any questions for me, Renee.
Yes, that is awesome. And I thank you for giving this broad overview, not too complex, about bonds. And I think that given the stage that we're in right now, there's going to be a higher interest in looking into bonds. So, having said that, given the space that we're in right now, the place that we're in, what would you say is the best type of bonds to be in right now, the best types of bonds to invest in?
That's a good question. And you'll probably find a lot when talking about fixed income that the answer to that question is usually that it depends, right? So it will depend on the end investor's goal for investing in fixed income. If they're looking to generate a consistent income stream, then you might look towards corporates. You might look towards a mix of corporates and government bonds. Maybe if they have a low risk profile, investment grade corporates are more of those high quality issuers that we were talking about. If the end investor has maybe an adversity to their purchasing power decreasing or they're worried about inflation, you could look at inflation linked bonds or TIPS, which are Treasury inflation protected securities that are government bonds that adjust according to expected inflation. And you can kind of look across those different asset classes to determine what niches within those asset classes underneath the umbrella of fixed income will best accommodate your investment objective.
Yeah, awesome. And I think, given the fact that we are in this stage with inflationary environment, that people are beginning to look at a means of kind of keeping their investments stronger and less impacted by this volatility that we're seeing in the markets. So, can you talk a little bit also? Are interest rates, the income that you receive off of bonds, fully taxable? Or what are some of the tax benefits? I know for certain kinds of bonds, there are some tax benefits.
Yeah, that's absolutely true. So there are taxable bonds, which are generally corporate bonds. There's government taxable bonds, which are taxed at ordinary income. But there's also bonds that are issued by municipalities and states, which have a tax benefit. Some of them are taxable, but a lot of them are federally and state tax exempt. So if you live in California and you buy a bond issued by a California municipality, it can potentially be tax-free on a state and federal level, which is pretty cool and pretty common to see California muni bond funds and also New York municipal bond funds and even national municipal bond funds, which even if they're not state specific, they'll typically be federal tax exempt.
Yeah, that's a big plus because there are some concerns that we might see changes in the tax laws. And so looking at some means of being able to keep your taxes at a low rate is really important. So the last question I would have for you, which I'm sure that a lot of people have an interest in knowing, what kinds of bonds do you think would be, or fixed income, it's the best place to be when we're in an inflationary environment because started last year and it's the highest level of inflation that we've had in 40 years.
Yeah.
Um, so, because I'm sure that that is an area that people are really wanting to figure out how to take advantage of this cycle that we're in right now. So, if you have some suggestions about the best types of bonds, fixed income instruments to be in.
Yeah, I think that in an environment like this, not only does inflation bring into question the purchasing power that you will have in the future of your current capital, but it also creates a little bit of volatility in the market because everybody's a little bit more worried about where that purchasing power is going and how the Fed and other entities are going to react to control inflation. So if it's a lower risk willing investor, then you want to look at things that maybe have a little bit of higher sensitivity to inflation. So things like the Treasury inflation protected securities that I mentioned earlier, or TIPS, that their principal adjusts according to CPI measures. So the coupon that you receive will be adjusted based off of what inflation is. So it inherently has inflation protection built into it, but it's also a government backed security. So it has a high quality aspect to it too. You can, if you're more willing to be more risk averse, look into um, corporations that issue bonds that are a little bit more sensitive to inflation, are able to change their prices, pass through prices to end clients or to consumers to be able to keep up with inflationary environments. And you can buy investment grade rated types of bonds from them or high yield bonds. But I think that in an environment like this, overall, while we think it is important to have that inflation protection, you also want to have diversification across various fixed income asset classes and a little bit of flexibility to be able to capitalize on areas that are opportunistic as they come up given volatility.
Awesome. Well, very good. This is going to be especially impactful as we head into this year. And let's take a picture of us. So if you can stop sharing your screen so they can see
Oh,
us.
absolutely.
To say thank you all for this. And we are working with Alex. And so as you get closer to getting a deeper understanding, because most people have been really wanting to focus in stocks, but now we're starting to move from being a growth oriented stage to be more value oriented. And that will include a lot more emphasis on things that pay a dividend or pay interest rates, and bonds definitely would be the best place to be. So, and PIMCO is at the top of the line, as you heard her say. It's the largest nationally. And so it's wonderful that they're not that far away from us, but we have clients all across the country. So you all can take advantage of PIMCO at any time. So, with that said, thank you so much for sharing all of that content and your background. And we look forward to working and spending more time with you.
Thanks, Renee.
All right. Thank you.